Welcome to this conceptual deep dive into customs law for CA final students. In this session, we will build a strong foundation by understanding the meaning and history of customs duty, the evolution of customs legislation in India, important constitutional provisions, key definitions, and crucial geographical boundaries such as territorial waters and Indian customs waters. These concepts may look theoretical, but they form the backbone of customs taxation and are frequently tested in MCQs, theory questions, and practical case studies. So rather than memorizing isolated provisions, let's understand the logic behind customs law and make the entire chapter easier to remember and apply. Let's begin with the basic concept of customs duty. Customs is an indirect tax imposed on goods that are imported into or exported from a country. Interestingly, the word customs originates from the word custom, meaning a habitual practice followed over time. The concept is not new. In ancient times, traders offered gifts to kings for permission to sell goods within their kingdoms. Even Kautilya's Arthashastra referred to shulka, a form of customs duty collected at city gates on both imports and exports. So while the laws have evolved, the idea of taxing cross-border trade has existed for centuries and remains a key source of government revenue today. The modern customs framework in India developed during the British era, when taxation on imported goods became formally organized through legislation. A major milestone came with the Customs Act 1962, which consolidated customs laws and replaced the Sea Customs Act, Inland Bonded Warehouses Act, and Land Customs Act. Later, the Customs Tariff Act 1975 replaced the Indian Tariff Act 1934 and was further amended to accommodate technological and industrial developments. For exam purposes, remember that today the Customs Act 1962 and the Customs Tariff Act 1975 together form the complete legal framework governing the levy, assessment, collection, and administration of customs duties in India. Every tax in India must derive its authority from the Constitution. The most important provision is Article 265, which clearly states that no tax shall be levied or collected except by authority of law. Article 245 empowers Parliament and state legislatures to make laws within their respective jurisdictions. A unique feature is that parliamentary laws are not invalid merely because they have extraterritorial operation. This becomes extremely relevant in customs law, because international trade often involves transactions extending beyond India's physical borders. Therefore, customs enforcement and taxation are firmly backed by constitutional authority, ensuring legal validity and effective regulation of cross-border movement of goods. To understand who has the power to levy customs duty, we must look at Article 246 and the 7th Schedule of the Constitution. Legislative subjects are divided into 3 lists: the Union List, State List, and Concurrent List. Customs falls under Entry 83 of the Union List, which grants Parliament exclusive power to levy customs duties, including export duties. Matters in the State List are generally handled by state legislatures, while subjects in the Concurrent List can be legislated upon by both Parliament and states. For customs law, the takeaway is simple. Only the Union government has the authority to impose customs duties, making it a centrally administered tax. Article 286 places important restrictions on state governments. A state cannot impose tax on supplies occurring outside the state, nor can it tax supplies taking place during import into India or export out of India. This constitutional safeguard prevents multiple taxation and protects international trade from unnecessary state-level interference. The Parliament alone has the power to determine whether a transaction qualifies as an import or export and to levy customs duties on such transactions. Therefore, whenever goods cross international borders, the authority shifts exclusively to the Union government, ensuring uniform treatment of customs matters across the entire country. The Customs Act 1962 serves as the primary procedural law governing customs administration in India. It extends to the whole of India and contains provisions relating to import, export, assessment, warehousing, confiscation, penalties, and appeals. One important feature is its extraterritorial applicability. Unless specifically stated otherwise, the Act can apply even to offenses or contraventions committed outside India. This broad jurisdiction helps authorities tackle smuggling and customs violations involving international transactions. Structurally, the Act is divided into 17 chapters, each dealing with a different aspect of customs administration, creating a comprehensive framework for regulating international trade. One of the most important definitions under Section 2(3)(a) is that of a beneficial owner. A beneficial owner is either the person on whose behalf goods are imported or exported, or the person who exercises effective control over those goods. The significance of this definition is that customs authorities focus on the real controlling party, rather than merely the person whose name appears in documents. Imagine an importer using intermediaries or agents to hide ownership. Even in such situations, the beneficial owner can still be held responsible. This definition plays a critical role in practical case studies, anti-evasion measures, and enforcement actions under customs law. Let's understand 3 important infrastructure-related definitions. First, the board refers to the Central Board of Indirect Taxes and Customs, or CBIC, constituted under the Central Boards of Revenue Act, 1963. Second, a customs area includes customs stations, warehouses, and any area where imported or export goods are ordinarily kept before customs clearance. Third, a customs station includes customs ports, customs airports, international courier terminals, foreign post offices, and land customs stations. Together, these definitions establish the physical and administrative framework through which customs authorities monitor, regulate, and clear goods entering or leaving the country. The Customs Act recognizes 3 categories of warehouses. A public warehouse, licensed under Section 57, is available for use by the general trading community. A private warehouse, licensed under Section 58, is generally used by a specific importer to store their own imported goods. A special warehouse, licensed under Section 58A, is designed for particular classes of goods requiring enhanced security or specialized storage conditions. Understanding these categories is important because warehousing affects the timing of customs duty payment and plays a significant role in import planning, logistics management, and duty deferment mechanisms. The taxable event in customs revolves around import and export. Under Section 2(23), import means bringing goods into India from a place outside India. Under Section 2(18), export means taking goods out of India to a place outside India. These definitions include grammatical variations and related expressions. While they appear simple, their practical application depends entirely on the legal definition of India and the geographical boundaries recognized under customs law. In other words, determining whether goods have actually crossed India's customs frontier becomes crucial in deciding whether customs duty is attracted. For customs purposes, India includes not only the land territory, but also the territorial waters of India, as defined under Section 2(27). To measure maritime zones, we first identify the baseline, which is the low water mark along the coast. Think of the baseline as the starting line from which all maritime distances are measured. Once the baseline is established, authorities can determine the extent of territorial waters, Indian customs waters, and other maritime zones. Understanding the baseline is essential because customs jurisdiction, taxation, and enforcement powers all depend upon distances measured from this point. Territorial waters of India extend up to 12 nautical miles from the baseline under the Maritime Zones Act, 1976. These waters form part of India itself. This means India's sovereignty extends over the sea surface, the airspace above it, and the seabed below it. A highly important exam concept is the deemed import rule. Goods are considered imported the moment a vessel crosses the imaginary 12 nautical mile boundary and enters India's territorial waters. Remember this carefully because many practical questions revolve around determining the exact moment when import legally takes place. Also remember the conversion. 1 nautical mile equals approximately 1.852 kilometers. Indian customs waters, defined under Section 2(28), extend far beyond territorial waters. They stretch up to the limit of the exclusive economic zone, which is 200 nautical miles from the baseline. These waters include bays, gulfs, harbors, creeks, and tidal rivers. While territorial sovereignty ends at 12 nautical miles, customs authorities continue to exercise significant enforcement powers throughout the entire 200 nautical mile zone. For exams, remember this distinction carefully. Territorial waters relate to sovereignty and importation, whereas Indian customs waters primarily provide an extended enforcement zone for customs authorities. The continental shelf refers to the underwater extension of a country's landmass beneath the sea. Geographically, it is the portion of the seabed where depth increases gradually before descending sharply into the deep ocean. Legally, India's continental shelf extends to the outer edge of the continental margin, or up to 200 nautical miles from the baseline, depending on applicable conditions. Another important point is that the maximum depth of seawater over the continental shelf is generally considered around 200 meters. Understanding this concept helps in appreciating maritime jurisdiction and the broader framework within which customs and other maritime laws operate. Customs authorities enjoy extensive powers throughout Indian customs waters. First, they can arrest individuals committing customs offenses within this zone. Second, prohibited goods or goods involved in smuggling activities may be confiscated. Third, vessels suspected of smuggling can be stopped, boarded, searched, and investigated. The key point is that these powers remain available throughout the entire 200 nautical mile Indian customs waters, even though India's territorial sovereignty ends at 12 nautical miles. Therefore, Indian customs waters function as a powerful enforcement zone that enables authorities to prevent and detect smuggling before goods actually reach Indian territory. All the concepts discussed so far ultimately support the levy and exemption provisions of customs law. The definitions of import, export, India, territorial waters, and customs waters help determine when a taxable event occurs and whether customs duty becomes payable. Similarly, exemptions can only be applied after correctly identifying the nature and location of the transaction. Therefore, before solving any customs duty problem, always establish the relevant geographical boundary and determine whether an import or export has legally occurred. This foundational approach makes customs law far easier to understand and apply in examinations. Let's quickly revise the most important points. Entry 83 of the Union List gives Parliament exclusive power to levy customs duties. The Customs Act, 1962, and Customs Tariff Act, 1975 together form the complete customs code. Territorial waters of India extend up to 12 nautical miles, and crossing this limit results in deemed import. Indian customs waters extend up to 200 nautical miles and provide enforcement powers such as arrest, confiscation, and vessel interception. Finally, remember the key definitions of beneficial owner, customs area, customs station, import, export, and India, because these definitions frequently appear in both theory questions and MCQs. As we conclude, remember that success in customs law comes from precision rather than approximation. Focus on mastering exact statutory definitions, particularly beneficial owner, import, export, customs area, and customs station. Equally important is understanding the distinction between the 12 nautical mile territorial waters limit and the 200 nautical mile Indian customs waters limit. Many exam questions are designed around this difference. Whenever you face a practical problem, avoid assumptions and apply the legal definitions strictly. If your concepts are clear and your definitions are accurate, customs law becomes one of the most scoring and predictable areas of the CA Final IDT syllabus. Welcome to Unit 2 of Customs Law, where we explore one of the most important areas for both examinations and practical application, levy and exemptions. Before calculating any customs duty, we must first understand when duty arises, why it arises, and under what circumstances it may be reduced or completely exempted. In this session, we'll examine the 3 stages of taxation, Section 12, the charging section of the Customs Act, landmark judicial decisions on taxable events, re-importation rules under Section 20, and important CBIC clarifications. By the end, you'll have a clear framework for solving customs levy questions with confidence and precision. Before we begin, let's understand the roadmap for this session. First, we'll study the 3 stages of taxation: levy, assessment, and collection. Then we'll dive into Section 12, the fundamental charging section of customs law. After that, we'll examine landmark judgments that determine the exact taxable event for imports and exports. Next, we'll discuss re-importation under Section 20 and the concessions available under Notification 45/2017. Finally, we'll cover CBIC's clarification regarding goods sent abroad for exhibition or consignment. These topics are heavily tested in CA final exams and form the foundation for many practical customs duty questions. Every tax, including customs duty, passes through 3 distinct stages. The first stage is levy, where the law declares that a particular transaction or property is liable to tax. The second stage is assessment, which determines the exact amount payable. An important exam point is that tax liability exists even before assessment takes place. Assessment merely quantifies it. The third stage is collection, where the government actually recovers the tax. For administrative convenience, collection may sometimes be postponed. Think of it like a restaurant bill. Deciding you must pay is levy. Calculating the bill amount is assessment, and actually paying it is collection. Customs duty liability depends on three broad factors. First is the event, meaning the goods involved, the timing, and the circumstances under which duty becomes payable. Second is the mechanism, which includes the procedures and systems used for determining and collecting duty. Third is the exemption aspect, where the government may reduce or eliminate duty in public interest or for economic policy objectives. Whenever you solve a customs problem, ask yourself three questions. What is the taxable event? How is duty determined and collected? Is any exemption available? These three questions often provide the complete solution framework for customs law questions. An important principle in customs taxation is equitability. Customs duty is levied on goods and not on the person importing them. Since it is a charge on goods, the economic burden is generally passed on to the ultimate consumer. For example, when an importer pays customs duty on imported electronics, that cost is normally included in the selling price charged to customers. Equitability requires that similar goods imported under similar circumstances should bear the same level of duty. This ensures fairness, avoids discrimination, and creates a level playing field among importers engaged in comparable transactions. Section 12 is the heart of customs levy and serves as the charging section of the Customs Act. It states that customs duty shall be levied at the rate specified under the Customs Tariff Act, 1975, or any other applicable law on goods imported into or exported from India. The taxable event is the import or export of goods. One frequently tested point is that government imports do not enjoy any blanket exemption. Government goods are generally treated the same as private imports unless a specific exemption notification applies. Thus, Section 12 creates the legal foundation for the entire customs duty system. A landmark judgment in Garden Silk Mills versus Union of India clarified the concept of taxable event for imports meant for home consumption. The Supreme Court held that import is a continuous process. It begins when goods enter India's territorial waters, but is completed only when they become part of the mass of goods within the country. Therefore, the taxable event occurs when goods reach the customs barriers and the bill of entry for home consumption is filed. This judgment resolved confusion regarding whether crossing territorial waters alone triggers customs duty. Remember the phrase, import starts at territorial waters but completes at customs clearance. The position is different when goods are imported for warehousing. According to the judgments in Union of India versus Apar Limited and Kiran Spinning Mills, goods stored in a bonded warehouse continue to remain under customs control. Even though they have physically entered India, the taxable event does not occur at the time of landing or entry into territorial waters. Instead, it arises only when the goods are cleared from the warehouse for home consumption. In simple terms, warehousing postpones duty liability. This distinction is extremely important because many examination questions test whether duty arises at import, warehousing, or final clearance. For exports, the law is comparatively straightforward. Export is considered complete when goods cross India's territorial waters. Since territorial waters extend up to 12 nautical miles from the baseline, crossing this boundary signifies completion of export. Consequently, if export duty is applicable, the taxable event is linked to this crossing of territorial waters. Unlike imports, where judicial interpretation developed the concept of a continuing process, exports generally reach completion at the point where goods leave Indian territorial waters. Understanding this distinction helps avoid confusion when dealing with import and export duty questions. Let's compare home consumption and warehousing. Under home consumption, customs duty is paid immediately and goods are released for use within India. Under warehousing, duty payment is deferred, allowing importers to store goods without immediate cash outflow. However, this benefit comes with safeguards. The importer must execute a bond equal to 3 times the assessed duty amount and remains liable for interest, rent, and storage charges. From a business perspective, warehousing improves cash flow management. From an examination perspective, remember that the taxable event for warehoused goods arises only when they are finally cleared from the warehouse. Section 20 deals with re-importation of goods into India. The general rule is simple. When goods that were previously exported are brought back into India, they are treated as fresh imports. As a result, they become liable to customs duty and must comply with all restrictions and conditions applicable to similar imported goods. However, applying this rule strictly could sometimes create hardship. Therefore, Notification 45/2017 provides several concessions in specific situations. These concessions modify the general rule and often appear in practical examination questions, making them an important area of study for CA final students. When goods exported under incentive schemes such as duty drawback, IGST refund, advance authorization, EPCG, DFIA, RODTEP, or similar schemes are re-imported, the concession is limited. The importer must generally repay the benefits or incentives previously enjoyed at the time of export. For certain schemes like advance authorization and EPCG, applicable IGST and compensation cess may also become payable. The logic is straightforward. If export incentives were granted because goods left India, those benefits should be reversed when the same goods return. Think of it as giving back the export advantage that was originally received. A special concession exists for goods exported for repairs and then re-imported. In such cases, customs duty is not charged on the full value of the goods. Instead, duty is calculated only on the fair cost of repairs carried out abroad, including the value of materials used. Additionally, insurance and freight charges for both outward and return journeys must be added. A useful formula to remember is duty value equals fair cost of repairs plus two-way insurance and freight. This provision ensures that customs duty applies only to the value added through repairs, rather than the entire value of the goods. To claim re-import concessions, certain mandatory conditions must be satisfied. First, the re-import must occur within the prescribed time limits, normally 5 years, though special limits apply in specific situations such as Bhutan or FTP schemes. Second, the re-imported goods must be the exact same goods that were originally exported. They should not have been remanufactured, recycled, melted, or substantially altered. Third, for repair-related cases, ownership of the goods must remain unchanged. These conditions ensure that concessions are granted only for genuine re-importation cases and not for disguised imports of different goods. Not every re-import qualifies for concessional treatment. Certain categories are specifically excluded. These include goods originally exported by 100% export-oriented units or free trade zone units, goods exported directly from public or private warehouses, and goods covered under the Fourth Schedule to the Central Excise Act, such as tobacco and petroleum products. Additionally, concessions are unavailable if the goods have been remanufactured, recycled, melted, or recast abroad. For exams, remember that satisfying the conditions alone is not enough. You must also verify that none of these disqualifying exceptions apply. CBIC issued an important clarification regarding goods sent abroad for exhibition or on a consignment basis. Under GST law, such movement is generally not treated as a supply because there is no consideration involved. Since it is not a supply, it is also not a zero-rated supply and does not require a letter of undertaking or payment of IGST. Consequently, no export incentive is normally claimed. Because no export benefit is taken, there is nothing to reverse when the goods return. This clarification significantly simplifies the treatment of exhibition and consignment goods under customs law. The practical outcome of the CBIC clarification is that re-imported exhibition or consignment goods generally attract NIL customs duty under the residuary category of Notification 45/2017. However, one critical condition must be remembered. The goods must be re-imported within 6 months from the date of the delivery challan. This benefit also extends to goods sent to related persons, distinct persons, principals, or agents abroad, provided the goods are returned without approval or acceptance. For examination purposes, the 6-month condition is extremely important and frequently tested in MCQs and practical case studies. Let's quickly revise the most important points. Customs taxation involves 3 stages: levy, assessment, and collection. Section 12 is the charging section and applies equally to government and private imports unless specifically exempted. For imports meant for home consumption, remember the Garden Silk Mills judgment. For warehoused goods, remember Apar Limited and Kiran's spinning mills. For repairs abroad, duty is charged on repair cost plus two-way freight and insurance. Re-import concessions require compliance with time limits, identity conditions, and ownership requirements. Finally, exhibition goods re-imported within 6 months generally attract NIL duty. As we conclude this chapter, remember that customs duty questions often appear complex because they involve timing, movement of goods, and multiple legal provisions. The key is to identify the taxable event first, then examine whether any exemption or concession applies. Focus particularly on Section 12, the judicial principles governing imports and exports, and the re-importation rules under Notification 45/2017. If you master these concepts and understand the logic behind them, customs levy questions become highly scoring and predictable. Keep revising the conditions, time limits, and landmark judgments, and you'll be well prepared for both theory and practical questions in the CA final examination.